Okay, this is the second problem that's still related to this winter sports company, and we're going to use the same data and now assume that winter sports reputation has diminished and other resorts in the vicinity are charging only $65 per ticket. So winter sports has become a price taker as opposed to a price setter. Excuse me, and won't be able to charge any more than its competitors. So at this price, winter sports managers believe they're still going to have the 750,000 skiers and snowboarders each season. So if they cannot reduce their costs, what profit will it earn? Okay, state your answer in dollars and as a percent of assets. Will the investors be happy with the profit level, and show your analysis? So let's take a look at the old one. We had our revenue is going to be 750,000 skiers at $65 a head is $48,750,000. And the costs are from our other, let's see if I can get to it. Here are our total costs from the other problem, from 8-2. Total costs were $41,250,000. Okay, so there's our costs. So operating income would be $7,500,000. Now, the desired operating income was $100 million of investment, $100 million in assets at 15% or $15 million. So we've got a shortfall of $7,500,000. Okay, so as a percentage of assets, the profit is $7,500,000 divided by 100,000 in assets gives us 7.5%. Okay, now the investors wanted 15%. Instead, they're only getting 7.5%. They obviously won't be happy with this because the expected return is less than the desired return, and stock prices may decline. Okay, all right, so we figured out the revenue, the new revenue less the costs gives us operating income, and then the difference between that and what we expected to make, okay, which was $15 million, is $7,500,000. It's too bad these two numbers are the same, but, just look at it till you get it straight. Assume that winter sports has found ways to cut its fixed costs to $30 million. What's the new target variable cost per skier? Okay, assuming that the investors want to earn 15% return on assets. Okay, so we're going to assume that we're going to earn this $15 million, and we've been able to cut fixed costs to $30 million. So what do variable costs have to be? Okay, right now I think it's $10 per skier, right? I think it is. Let's go back to this other one. Yeah, $10 per person. That was our variable costs. So let's see what it has to be. Revenue at market, again, is $48,750,000. Desired profit is $15 million. So now our total cost has to be $33,750,000. We know that we've reduced fixed costs to $30 million, so targeted variable costs have to be $37,550,000. $3,750,000. We divide that by the number of skiers and find that the target variable cost per skier is $5 per person. Okay, so we've still got to reduce the costs even more. The target variable cost is 50% of the current variable cost of 10. And the company might have a hard time achieving this. It's going to take some creativity, to say the least. But it's a good exercise. And these two problems together are nice because they show you the company once as a price setter and what the calculation would be, and another is a price taker. All right, now be careful with this because this is one of those topics that looks okay, especially when I do it or when we review a problem, but you go to do it yourself and you notice that you don't really know what you're doing. So do these same problems without looking at anything else, without looking at the solution. Okay.